Hello and welcome back to Topic Tuesday with Alan Dembski and Juliana Jansen from Buffalo First Wealth Management. Today we have a great topic as we get ready and for the hustle and bustle of the holiday season. The weather is certainly starting to change here in Buffalo, New York. Hopefully some other places are nicer. But we're going to talk today about some end of year tax planning ideas and strategies. We could probably spend hours on each topic, but we're going to give a quick rundown today in this short video to just have to look out for some things that might uh, be pertinent to your personal situation. A lot of tax planning strategies need to be done before the end of the year, December 31st. Um, Sometimes the market or it's a work day, sometimes it's on a holiday, sometimes it's a little bit sooner than December 31st. But this year, December 31st is on a Wednesday, so you have a few days, Monday and Tuesday, to make any necessary changes. But as we're going to start out this video by talking about some of the things that don't need to be done before December 31st that you actually have up until April 15th. And the reason we're starting with that is the list is a lot shorter. So we're going to make that one nice and easy. But the first one that I'm going to mention is contributions to an IRA or a Roth IRA. Those contributions generally need to be done before you file your taxes, or if you're waiting until April 15th, to make sure that you do that. So making sure that you let your accountant know that those contributions are going in, so everything could be squared away for the previous year on your income taxes. Now, just remember, traditional IRA can potentially reduce your income depending on what your income is. And then a Roth is after tax, which will not lower your income, but you're still supposed to report that to the IRS when making those Roth contributions.
Yeah, and in addition to the IRA contributions, you can also delay your health savings account contributions until April 15th. And health savings accounts are for individuals that have a high deductible plan that allows contributions into an HSA. And it's the amount that you can contribute depends on whether you're single, married, or whether or not you're over 55, because catch-up contributions are allowed. Those can be made up until April 15th.
All right, there's a nice short list of things that need to be done or that can be done after December 31st. Now we're going to go into a longer list of things that need to be done before December 31st. The first thing I'm going to talk about is tax loss harvesting. It's a familiar term with a lot of people, and essentially what you're doing is selling any losses that you have during the year, maybe long-term or short-term, that you're selling to offset any possible gains that you've incurred throughout the year. Now, the one thing I will just remind people is that many mutual funds, if you own mutual funds, their capital gain distributions are generally November, December, and there is an X date. So if you own that particular mutual fund, after that X date, you're still going to have to declare those gains on your tax return. So tax loss harvesting, again, selling losses to offset any gains that you have throughout the year.
And Alan mentioned Roth IRAs. Some people have determined, and it's a whole process to determine whether it's right for you or not, but if it's been determined that converting your traditional IRA into a Roth IRA is the right move for you, that must be done by the end of the year. And a lot of people, because the contributions can be delayed until April, they think that they can convert up until April and have it count for the previous year. But actually, Roth conversions have to be done by the end of the year in order for a tax treatment purposes.
Yeah, and certainly make sure you let your tax preparer know that you did that because those actual forms, that confirmation forms, don't come out until May on the 5498. Don't ask me why they're May. Have this conversation every year with clients. But the other thing is RMD. So if you have an inherited IRA, or if you're over 73, You have to take your RMDs before December 31st of that year to satisfy that requirement, which could potentially bump you up if you haven't planned throughout the year. That could make some tax planning a little bit uh, different for many people, depending on how much RMDs they're taking if they didn't plan for that previously.
A lot of people have flexible spending accounts. Those are accounts where you put money aside and you can spend it on health services or health products. That spend also needs to be done typically by the end of the year. There are some plans that have built into them the ability to extend it into a grace period, but you would really want to make sure you check with your employer to see whether or not your plan allows for the grace period. And it's always just safer just to assume that it has to be done by the end of the year. Now, one point, if you have the health savings account that I was talking about earlier, that does not need to be spent by the end of the year. And amounts in the health savings account can be rolled over from year to year. And often we counsel people that that's a very good tax plan to use for health expenses in your retirement. So those do not need to be spent down. Flexible spending accounts do need to be spent down.
Yeah, and that's where a lot of people can, just that little nuance, the F and the H, throw a lot of people off. FSA, HSA, it gets a lot
Yep.
of people confused, but there is a distinct difference between the two types of accounts. The,
Absolutely.
the
We talk to a lot of clients that think, "Oh, I don't have to spend all of my HSA in one year." No, and it's actually a nice thing, especially if it's invested, because you can invest your health savings account. That can be carried over, and it's a great tool for a lot of people.
Absolutely. Um, Also, 529 contributions need to be, so 529 is our college savings program. Every state has their own program as long as, well, all contributions need to be done before December 31st into the 529 for that calendar year. And just note, some states give a tax deduction. Not all states, but some states, if you use that preferred plan in that state, you can get a state deduction for 529 for your kids' college education savings.
And the last thing on our list is a charitable contribution. If you are able to deduct charitable contributions, you're going to want to make sure that you make those contributions by the end of the year.
Yeah, so that pretty much wraps up our short uh, tax planning strategies for the end of the year. Certainly, we're here to help and navigate people through, but those are some of the most popular ones that we see. There's a whole array of different tax strategies that you can do. And again, like I said at the beginning, and I'll say it again, you can spend an hour on each one. But we just wanted to give you a quick summary to help you prepare for the last few months of the year as we head into that holiday season again. If there's any topics, certainly reach out to us and we can make a video on it. Please follow us on our YouTube channel at Buffalo First Wealth Management LLC, and follow us on all the social media channels. But for this Tuesday, we thank you for joining us and have a great day.